Tariff woes and weak economic data have driven volatility over the past few weeks. Just because the headline indices have given up all their year-to-date gains, this doesn't mean there isn't value to be found in the market. Joining me now to talk about that, we've got Michael Sonnenfeldt. He is the founder and chairman of Tiger 21. It's a peer membership organization for ultra high net worth investors. Michael, it's great to speak with you because you can give us such a great pulse on what the ultra wealthy are thinking about this market. Just give me the headline here. How are you hearing investors talk about this kind of rise in pessimism we're seeing in the market versus where the market's currently at?
More turmoil and confusion than normal. It's a period of great volatility. And our members are not just ultra high net worth, they're all former entrepreneurs who have built businesses mostly from scratch. The overwhelming number of our 1,600 members are first generation wealth creators. So they've been creating wealth in the private markets primarily.
And talk to me about why value investing is being viewed as the right way to allocate capital right now.
So value is seen in a lot of different ways. Our asset allocation has over half of our members' assets, about $200 billion collectively, in private equity and private real estate. That's where members are finding a lot of value. We only have about a 23% exposure to the public equity and mostly in the ETF. But there's some trends that people notice. For instance, we had a low cash in the fourth quarter. The last time we had below 10%, it's 9% now, was in 2007. So it's a little reminiscent. Same thing happened with Berkshire Hathaway.
Right.
They have the highest cash now, and they had the highest cash right before 2007. You can look at housing starts as an indicator, or houses for sale. So there's a lot of indicators saying there's a rotation in the market out of growth and into value. You can play it on ETFs. You have the Russell 2000, you have IJS, but those are really defensive moves. The thing that our members know is if you're buying a company, forget the momentum. On average, look at the fundamentals. It's a company, you're buying a piece of it. How will it do? Our members are very meat and potatoes oriented of basics. And this is a time where basics are really going to shine through.
So it also sounds like you're saying it's a stock picker's market a little bit.
Well, it's always a stock picker's market if you can pick great stocks. But over the long term, the evidence is overwhelming that indexes in buying the market is the better play for the long term. Some people aren't thinking the long term, they're thinking the short term.
Right. Well, and it's interesting hearing you talk about small caps, but they're off their highs, down 15% today since November. So it is a challenging environment to find that value. I also heard you talk about private credit opportunities. How can retail investors play that area of the market?
Well, there are a number of publicly traded private credit companies. The BDCs in particular, Golub would be one that's widely held among Tiger members, but there are many. I think Blackstone has one and many others. So as a category, when you're talking about value investing, depending how you look at it, the fact that a loan is at a proportion of the value, you're already having the protection of the equity above the loan. So if you really want some downside protection, if you can get private credit where the credit is independent, meaning it's floating credit, not taking the interest rate risk, that might be a better play.
What's your highest conviction trade amid this policy uncertainty?
Staying away from the fads. Our members are in private credit, our members are in private real estate. Anything that's sort of meat and potatoes. Apartment houses would be a good example.
I'm not hearing AI, I'm not hearing tech.
We have a huge exposure to AI. The Magnificent Seven has been on our radar for the last 3 years. Obviously, it's down about 10% this year. But when you say down 10%, it was up 60% last year. So it depends when you focus in that lens, how closely are you looking? And when our members get in our meetings and somebody says, well, it's down 10%, what should I do? They say, well, if you didn't know that it's a better deal when it's down 10%, you shouldn't own it in the first place. But if you look at a longer term perspective, the Magnificent Seven still have extraordinary franchises, even though there seems to be some sector rotation out of that.
I like that mentality. If you wouldn't buy the dip, then you're not high conviction enough to own that individual name. Thank you so much for joining us and breaking that down. Really appreciate it.